Isaah Mhlanga is from Alexander Forbes. He is executive economist there, and Gina Schoeman is the country economist for South Africa at Citibank. I'm Bruce Whitfield. This is Taking Stock, and taking stock of what's been a really rough year economically for South Africa, and trying to get some sort of sense as to what 2019 might look like. We'll discuss the prospects of whether we can withstand another ratings downgrade in the last part of the show. But first, some decent economic news coming through for once. We've seen the oil price drop from the mid-$80 level down to levels closer to 60. A recovery in emerging market currencies, including the rand, took a lot of pressure off the Central Energy Fund, and we saw a massive R1.84 a litre petrol price cut come through in December, and there's a strong possibility that we could get another cut coming through on the first Wednesday in January. That should have a positive impact on inflation. Crossing my fingers because I don't understand economics anymore. But, I mean, the theory goes, Gina Schoeman, that that's what should happen.
It is what will happen in December for sure. We'll have to see what January's petrol price is. But we've just today received the November CPI numbers, and we had a print of 5.2%. But the reason
that is up on October.
Slightly, ever so slightly, or 5.1. But the roller coaster ride is going to now start, because when we get the December print, which we only get in January, you're going to see CPI dive bomb to around 4.5% because of the massive petrol price and diesel price cuts that we saw. Obviously, continuing this into January will help to keep inflation below 5%. And that does change the starting point of a trajectory when you're forecasting inflation. I mean, our inflation numbers for 2019 are very low by comparison to, say, the Reserve Bank or even National Treasury. We think inflation could easily end up averaging around 5%, if not surprising slightly to the downside. We just think that pass-through in this economy is very much lower than what anyone expects, because the consumers are weak.
Because there's no activity.
There is no activity.
Yeah, we're not going, we're not borrowing, we're not spending. Lots of people in the malls not carrying any bags. It's a problem.
The big risk, though, is these declines in petrol prices are because of two things we can't control: oil price and the dollar-rand exchange rate. If you look at why the sub hiked, it was because of the risks that come from outside of our own control. And those risks are still very much present.
So the Reserve Bank was right to raise interest rates, even though inflation will show a downward move.
I don't think they were right to raise interest rates, because there was so much concern about external shocks which we can't forecast with any level of certainty, and we can't do anything about it. So I don't think it was right to hike rates because of global shocks, given that domestically we don't have any demand push pressures. We don't have a consumer that is rampant in terms of spending. The economy is weak. It was in recession at that point in time. And for me, it wasn't, it wasn't justified for them to hike. They could have stayed put and see how the risk manifests into January, to give people an opportunity at least to enjoy the Christmas festive season with low price, low petrol price, and also unchanged interest rates.
It would have been a nice little boost. Were they right or wrong, Gina Schoeman?
According to my forecast, they didn't have to hike, but they don't base their decisions on my forecast. Their forecasts
we will have a word.
So I think where I can see it justifiable is that in the end, our Reserve Bank has massive credibility in the emerging market space. So let's just put that out there. And we've always said, thank goodness, we've got still that institutional strength in South Africa. I think it's guarded us against a lot worse that could have happened. Secondly, they are very much concerned that if we had a walk around the street and ask people what they thought inflation would be next year, you're likely to get a number someplace around 5.5%, 6%.
Well, nobody believes the official inflation numbers, because our own inflation baskets reflect something completely different to the Stats SA CPI. It's just the reality of life.
That's true, but generally people think that inflation will be higher than the midpoint, which is 4.5%. Now, what that's
called an inflation expectation, right?
Absolutely.
And because I expect prices to go up, it creates room for people to push prices up. Prices go up, I expect them to go up more. Yeah. It becomes a vicious cycle.
And wages, because a lot of wages are indexed to CPI. So if you start expecting CPI to be somewhere and it ends up.
But then explain the anomaly here, because this year, for the first time in years, there's actually been a contraction in wage expectations. Wage inflation has actually been fairly muted. That's weird.
It has been, but for a very long time, unions have managed to negotiate for well above inflation wage increases, which for me is quite problematic for the sub, because they're trying to say, push your wage expectations towards the 4.5%, but unions are not buying it. They continue to get well above inflation. And for me, if they are not able to negotiate, or at least to force the unions to moderate their wage expectations, then it means they're going to hike interest rates continuously because they're not going to be able to anchor inflation expectations towards the midpoint. That is one of their biggest problems.
Would you agree with my dentist, who, when you sit in the dentist chair and you open your mouth and they immediately stick their tools into your mouth and start fiddling about and then ask you questions. And then when you don't answer because you can't, they give you their opinions. You know those people. My dentist, if he was finance minister, would cut interest rates by 300 basis points tomorrow to stimulate growth. Now, that would destroy the credibility of the Reserve Bank, but it would stimulate some growth. Would it push inflation out of control?
It may push inflation out of control. But I think our growth issues are not because monetary policy is too tight. In actual fact, if you look at real rates, it's still quite accommodative. So cutting interest rates is not the solution.
Interest rates are not the problem.
It's not the problem. Perhaps over the short term, they could boost growth, but over the long term, that will actually hurt economic growth over the long term. So it's not the solution.
And next time I'll go and I'll get the first word in. When I go at reception, I'll say that and keep him off my back.
Yeah, let's be fair. The Reserve Bank of South Africa is the only institution we have to fight inflation. Yeah. We have hundreds of committees and departments and ministries whose sole objective is to create growth. And that's where the problem lies.
They're not doing their job.
It's a structural problem. You can't lean on the Reserve Bank of South Africa and say, well, you should cut rates in order to stimulate growth. It's not their job. It wasn't what they were designed to do.
So if I can add to that, we have always had good macroeconomic policy settings. Treasury, the SARB, works quite perfectly. But where we have been lacking is the microeconomic reforms in the various sectors where growth actually takes place. We have not been able to actually make the right changes that boost economic growth. The cost base of this country is way too high across all the sectors, which means we are not competitive relative to other countries.
We're not going to create new mining under the current mining regime. We're not going to create new industry under the current DTI regime. We're not creating small businesses under the small business regime. What we need, perhaps, is a change in thinking of a regime, and maybe that comes at elections 2019. Is that going to be the catalyst for South Africa, or are we just using it as a staging post, perhaps, for the next round of excuses as to why South Africa perpetually underperforms? More in a moment.